Welcome to Real Estate Investor Talk. My name is Neil Peterson, and with me today is Renier Kriek. He's Managing Director of Sentinel Homes. So welcome to you, Renier. Great having you on the show.
Thanks, Neil. Nice to see you again.
Yeah, absolutely. So today we want to gain, a little bit of insight into, what's actually happening into the property market landscape. And I think we're going to focus on, the anticipated changes we're expecting in the repo rates and interest rates. Which I think can bring much needed relief in our economy. In fact, I say it is the elephant in the room in terms of the SA property market and our economy going forward right now. I'm sure Renier will agree with me. But before that, let's explore some of the economic policies, both domestic and international, and how it could shape the landscape of property development and investment in South Africa, particularly in the context of anticipated, as we say, in interest rate changes and political developments. Okay, so Renier, maybe you can, let's get into this. So maybe with the South African Reserve Bank Monetary Policy Committee potentially announcing an interest rate cut, how do you foresee this impacting the South African property market, and particularly in terms of affordability and buyer sentiment?
Neil, so I don't think that they're going to be announcing a cut on Thursday, the 18th, when we expect the MPC to announce the result of their deliberations. I think we've have a very hawkish bunch in panel there, led by the chief among the hawks, the governor. And I think that they're going to be cautious. I agree with some of the analysts that have predicted that the decision to halt rates may not be unanimous. Some of the panel members may, favor a cut, which I think will be an indication of the fact that, the cut is coming in September. It seems almost incontrovertible now, if we look at the bond trading in the USA, that the Fed will start cutting, and that the cutting initially will be deeper than initially anticipated. Many of the bond markets and bond traders now predicting 50 basis points from the Fed in September, and their meeting is just before ours in September. And if the Fed cuts, then I think the House of Cards will come down, and the MPC will have to vote in favor of a cut in September as well.
But I see Goldman Sachs has suggested a possible 2% rate cut cycle. I mean, it's differing completely from market consensus. So maybe what are your thoughts on how such a significant rate adjustment could influence property investment trends and your mortgage bond affordability?
Yeah, so I think we can see very clearly from the statistics that housing consumers are significantly under pressure. Normally about 8% through the cycle of bond accounts have some form of arrears on them. And that's the last time we have a measurement from the National Credit Regulator is for the first quarter of 2024. And that number has gone to more than 12%. So it's a 50% increase in bond accounts that have some form of arrears, which is an indication of distress. There are others as well, of course, but I think that's a nice spotted one. The fact is that consumers have been sort of battered by the storm of high inflation and high interest rates, and many of these things are not things that consumers can escape, like the high rises in electricity prices and food prices. You need to eat and you need to have lights. Those aren't optional things. It's not as though increasing interest rates really dampen spending on those items, even though it does reduce demand in the economy on the whole. So we understand that the Reserve Bank is inflation targeting, and that by increasing interest rates, they're reducing consumer spending and demand in the economy, which then dampens inflation, which achieves their objectives. But it's not been great for consumers who are struggling. And so affordability is a very big constraint because of that. Everything has become more expensive off the back of the inflation and of the interest rate increases, as producers and sellers in the market try to recover their costs, etc. So consumers are significantly under stress. We can see that starting to spill out into the statistics, although it's not really manifested in the form of sort of panic selling in the property market. We haven't seen that yet, but that's just because bond defaults have long lead times before they lead to sales. It's about the bank will give you 12 months of negotiation after you first defaulted before they really start taking action. And by that time only you see things like people signing easy sell mandates. And if you're waiting for sheriff's auctions, that takes even longer down the cycle. And so what we're hoping for is that this terrible perfect storm of positive reinforcement of all of the negative things that are happening to consumers, that'll be halted. And the two things that our hopes are on is firstly some form of economic revival led by the positive sentiment created by the political outcome that we had after the election, and then the very tangible one, the one that sort of is shouted from the rooftops, which is if the SARB starts cutting rates, because it's been predicted for long, and so consumers have seen these predictions, but from past experience, we know that the market doesn't really react until we see the actual signal. And so until that signal arrives, I don't think, the metrics in the property market will change. It probably remain a buyer's market until then. You see, we have a lot of positive sentiment at the moment driven by the politics, but that positive sentiment has not yet created tangible benefits for the consumer. And so it's not really spilled into any sort of economic revival. It's too short. There's not enough time. It is unrealistic to expect it to have happened. And so the real thing we need now is that interest rate cut. But unfortunately, I think Goldman Sachs is a little too bullish, if I may disagree with them. Far be it from me to claim that I know more than Goldman Sachs about the economy, but they are out of consensus. And the general consensus seems to be that though there is a moderate chance for a cut, the bond market trading predicts about 50% chance, just shy of 50% chance for a cut. It seems as though the real magic is going to happen in September only.
Okay, right. It's a valid point. So considering high inflation and interest rates post-COVID, we've seen that mortgage bond arrears have risen notably, as you've said. I mean, how should property developers and homeowners prepare for potential economic volatility? And you mentioned it. And so what strategies can mitigate financial risk in this environment?
Yeah, I mean, when we're talking about personal finances, you must do the obvious things, right? There are 1,001 advice columns, but be careful of recurring expenses like unused gym subscriptions and unused Netflix or Showmax, or don't have Netflix and Showmax and Apple TV and Disney Plus and Hulu and Apple. These normal sort of budgeting type things. Make sure you have a budget. Make sure you know what your actual expenses are. Make sure you measure your expenses against the budget. All of these personal finance things that we're supposed to be taught in school, but regrettably are not. These are sound, sort of pieces of advice. People must strive to pay down debt rather than splurging on luxuries, because we definitely, as a consumer society in South Africa, need to batten down the hatches a little bit until things have changed. And that's precisely why we have high interest rates, right? It's because the SARB wants to encourage us to do that.
Okay. Good point. I think, yes, carry on.
No, sorry, you go. I haven't answered all of the question, but you asked the follow-up.
But I mean, it just in terms of that, for some people, it's quite scary, to do all those cuts and what have you. But I think you brought out some really valid points. I mean, you're not the first person to say that, the consumer is over indebted. I mean, it's obvious. We're just seeing, and obviously this higher interest rate environment is, it's gone on longer than we expected. And the cuts that you recommended are needed. It's austerity measures.
Yeah, personal finance austerity. That is a little bit of a requirement.
Yeah.
The interesting thing is that obviously that the stress is not equally distributed. It never is.
Yeah.
And so there are pockets in the property market where there is still high activity and significant price growth. But on a balance, the South African property market is currently a buyer's market. Mortgage bond application rates are down. But there's always light at the end of every tunnel. And so what we've seen, what's a very interesting trend, is that the proportion of property purchases that are made for investment has skyrocketed. That number is usually about 1 in 20. And at the moment, it's about 1 in 8 using national statistics. And in the Western Cape, it's close to 1 in 3 properties being purchased for investment properties.
Oh, wow. Okay, that's very interesting stats.
And so if you want to, it's good advice, I think, in any market, whether it's equities, bonds, rare art, coins, whatever, and also for real estate. If you want to make money in the real estate market, one possible avenue is follow the smart money, right? Because if we look at the statistics, who are these people who are buying for investment purposes? They're generally older, richer consumers who are not buying their first property, and they are taking a bet now. They're venturing into the market because they view this as a sort of a low point, a point where bargains or value can be achieved. Now, if you're living, say, in the Western Cape, where property prices have run amok because of immigration and other reasons, then that might feel strange to you because property is fast becoming entirely unaffordable to the average consumer in the Western Cape. Property prices are growing much faster and taking flight above the median wage affordability level. Then this might feel to you as though it's unlikely, you know, prices surely can't go up further. Problem is that is going to happen. There is pent-up demand in the market because in the past 18 to 24 months, property trading volumes have been down. And the fact is that people trade property because their life cycle changes. You know, you get divorced, you sell your property. Your children, your teenagers move out the house, you sell your property, buy a smaller one. Your small children become bigger, you buy a bigger one because you need a garden, whatever. And those things happen irrespective of high inflation and high interest rates and political instability and whatever. And usually they manifest as property trading. But when they don't, that means that those things have happened in the background and there's pent-up demand for property trading to happen. And so then as soon as the sort of dam is pricked, all of that pent-up volume comes spilling into the market, creates a high demand. And the property market is just not elastic enough to take high increases in demand and adjust the supply quickly. You know, it takes... I spoke to my brother who runs the family business. He's a developer. He said that they had this developers forum meeting where they said 30 years ago, the average approval from brownfields to the point where you had your approval to start a development was about 18 months. These days, the average EIA takes 24, and you can't start the rest of the process until you have the EIA. So the subdivision and rezoning application doesn't even go in. That means that there are tremendous lead times, 3, 4, 5, 6, 7 years in advance that you start planning property, that you start planning the increase of supply, new development of new housing stock. And the fact of the matter is that if volumes increase suddenly, then the supply just can't come into the market quick enough. And these things, obviously, even if you had the project planned, you still need to build it. You need to achieve the pre-sales to get the funding to build it. And those things take time. So that pent-up demand is going to come spilling into the market. I think it's going to have some interesting effects when it does arrive. One of the effects, I think, is that it is going to serve to slightly decrease the rate of semigration, or perhaps even marginally reverse the semigration trend, because semigration to coastal areas, especially the Western Cape, is not sustainable because there's just not enough supply creation in the semigration destinations. Even though the semigration destinations outpace the balance of the country in, say, building plan approvals. So we see that the market is making some adjustments. It's just never going to be quick enough. And the people are fast making coming to the realization that there's an affordability differential. If you want to rent a property in Somerset West, you pay 35,000 rand for something that you could rent in Randburg for 15. And you may semigrate, but your income may not change. So then living in the Western Cape is a much more expensive proposition. So the places like the east of Pretoria suddenly is looking exceptionally cheap, and you may not want to leave that area to come to Durbanville, where everything is exceptionally expensive. So it's definitely interesting times ahead, and I think that those who are in the market are in for a nice kick up in their equity values. And I, for one, am looking forward to it.
Okay, great. And interesting here at the Reside Summit, where I was moderating a few events. There was one interesting point that was made, came out from research from the Affordable Housing Association, which is very interesting, that applications, and we're talking about development applications, 80% of the time spent is spent in time and energy of developers on applying through municipalities. And so the last 20% is the easy part. That's the rollout of the development. So I've got a question for you. So if interest rates remain high or economic productivity stagnates due to political sentiment, what do you anticipate could be the short-term and long-term impacts on bank earnings and also the broader property market?
So if you want to short some bank stocks, I'd say do it now. The banks are going to have to announce their interim results soon, and those interim results are not going to look great because they're going to be impairment charges and things likely to be passed, because mortgage bonds make up the backbone of the bank's balance, of all of the bank's balance sheets. And so if the residential property sector is not doing well and consumers are defaulting, then The banks are going to have to impair their exposures on the balance sheets, and then that's not going to look good, also not for earnings. The economic activity in general is dampened, and so the financial sector will suffer under that. And so if I were an equity analyst or an equity investor, I'm neither, then I think, shorting some bank stocks might be a good idea as a general proposition. Obviously, there are some exceptions and whatever to this rule, I'm sure. But I mean, Neil, I think that, I'm very positive about the trajectory that our country has taken. Prior to the election, when you and I met each other at that conference,
Yes.
we looked at what could happen in the elections, and I think this was punted as the best. The outcome that we have was punted as the best case scenario, right?
Yeah.
And so we got the best possible deal. Despite what Jan Smuts had to say, right? South Africa is the place where the best never happens, but the worst also doesn't. For once now, we got the best possible outcome. And so the right noises are being made already. I think having more parties in government throw open the shutters so that the sunlight can sterilize all of those areas that previously were very mucky. We have an amazing country that has an amazing potential, and all we need at least a semblance of efficiency and competence at the helm, which we have been sadly lacking for very long. Not because the ANC doesn't have the people, just because the people they have were not in the spots, right? And so I don't like the downside scenario, because I firstly don't see it happening from here. I think we just have to bide our time until sentiment spills into the market. If we have the rate cut, the rand, because we're an importer of inflation, the foreign exchange rates look positive for a bit. The oil price is coming down. There's some geopolitical instability that's sort of adding to the load on our backs, but hopefully that can be sorted out, or at least become old news, so that we're not so sort of shaken around by it, as we seem to be. Then I think, the Reserve Bank announces economic maximums, right? The top economic, they measure the economy and they map the economic peaks of the cycle. And if I stand to be correct, but the last peak of the cycle was in November 2013. So for the past, say, 11 years, we've been laboring in what is really a floundering economy. And people also get bored. Don't underestimate, I think, the impact of boredom on turning the economic cycle around. So I think most people have been bored for long, and they've just been waiting for the siren call. And I think the politics and the turning of the interest rate cycle will constitute that call, and will sort of lift us out of the slump.
Okay, wonderful. Well, great chatting to you as always, Renier. Really some valuable points I think you brought forward there. And we look forward to chatting to you again. And yeah, well, let's watch those interest rates. We're going to be watching it very carefully, I think, on Thursday. But as you said, no surprises. Good chatting to you, Renier, and we chat.